You've worked for decades, you've paid your dues, and now it's finally time to collect Social Security. But for millions of retirees, there's a nasty surprise waiting in the mail, a tax bill on the very benefits they were counting on. Okay, let's dive into this Social Security tax trap and figure out how it really works.
All right, so let's just get right to it. The number that shocks almost everyone is this. Up to 85% of your Social Security benefits can be subject to federal income tax. Nope, that's not a typo. For a lot of retirees, a huge chunk of their benefits won't be tax-free at all.
And look, this is the first thing everybody says, and it makes complete sense. I paid FICA taxes my whole career, out of every single paycheck. Why on earth am I being taxed on this money again? It's a totally fair question, but, well, the government sees it a little differently. See, the government isn't looking at this like they're just giving you your money back. Nope. To them, it's a form of income. And here's the real kicker. The tax isn't even based on your Social Security alone. It's actually triggered by your other income.
This is so important to understand. The amount of Social Security you get isn't really the issue. Your benefits just kind of sit there, waiting. It's the money you pull from your pension, from your traditional 401k or IRA. That's what trips the wire and suddenly makes your Social Security benefits taxable.
So how do they figure all this out? Well, the IRS doesn't use your normal everyday income. They have this special, kind of weird formula they use to calculate something called provisional income. And this number exists for one reason and one reason only: to figure out if your Social Security benefits get taxed.
Yeah, think of it just like that. A specific recipe the IRS cooks up. It's a blend of a few different income sources, and the final number you get is what they compare against a set of thresholds to see how much, if any, of your Social Security is subject to tax. That's it.
Okay, so what's in this recipe? You start with your adjusted gross income. That's stuff like your pension or IRA withdrawals. Then you add in any tax-exempt interest, maybe from municipal bonds. And then, and this is the part that always gets me, you add back half of your Social Security benefits, just to figure out if you're going to be taxed on those benefits. Yeah, it's a little circular, but that's how it works.
So once you have that provisional income number, you just line it up against these thresholds. For a single person, if you're under 25 grand, hey, you're good to go. Zero tax on your benefits. But once you go over that, the tax kicks in, and up to 50% of your benefits become taxable. And then if you cross $34,000, that jumps to 85%. And you can see the numbers are a bit higher if you're married and filing jointly.
And this slide right here, this is the whole problem in a nutshell. These numbers, these thresholds, they haven't been touched since 1993. They are not adjusted for inflation. Just think about that for a second. 34 grand back then is nothing like it is today. If they had just let it keep up with inflation, that top number would be over $75,000. This is what they call bracket creep, and it's why more and more people are falling into this trap every single year.
Okay, so theory is one thing. Let's look at how this plays out in the real world with a few examples. This is where you really see how one little decision can totally change your tax situation.
All right, scenario one, super simple. Let's say a single retiree gets $24,000 a year from Social Security, and that's it, no other income. So their provisional income is just half of that, which is $12,000. That's way below the $25,000 line, so zero tax on their benefits. Simple as that.
Okay, now let's add just one thing, a $20,000 pension. They still have that same $24,000 in Social Security, but now the formula is the $20,000 from the pension plus half their Social Security, which is still $12,000. You add those up, and you get a provisional income of $32,000. And bam, just like that, they've crossed into that middle tier. Now up to 50% of their Social Security is on the table for taxes.
All right, one more tweak. Same $24,000 in Social Security, but this time, instead of a pension, they pull $30,000 out of a traditional IRA. So their provisional income is that $30,000 plus the $12,000 for a total of $42,000. Now they're over the top threshold, and up to 85% of their Social Security benefits are now considered taxable income. This right here is what planners call the double impact, and it's brutal. That $30,000 they took from the IRA, that's taxable, of course. But on top of that, taking it out also triggered the tax on their Social Security. So you see, one move, two tax hits.
So we've got the basics down, but believe it or not, it gets even more complicated. There are some serious hidden traps here, but also some really powerful ways to plan around them.
First up, let's talk about something called the tax torpedo.
Now, this isn't some official IRS term you'll find on a form, but it perfectly captures what happens when you're in that zone between the 50% and 85% taxability levels. It is a danger zone where your tax rate can just, well, explode.
So how does this thing work? It's kind of wild. When you're in that zone, if you take out $1 extra from your IRA, it doesn't just add $1 to your taxable income. No, because that $1 also forces 85 cents of your Social Security to become taxable. So $1 of income just created $1.85 of taxable income. Your real tax rate, your effective rate, just goes through the roof, way higher than what your tax bracket says it is.
And this brings us to the single biggest, most important strategy for dealing with all of this. Roth IRAs. Why? Because Roth IRA withdrawals do not count in that provisional income formula. I mean, just look at this comparison. A retiree pulls $40,000 from a traditional IRA, they end up with a tax bill of about $4,600, mainly because it lit up their Social Security. Now look at the other person, same income, but they pull their $40,000 from a Roth IRA. Their total federal tax bill? Zero. Nothing. That's not a small difference. That is a complete game changer.
Okay, so understanding the trap is step one. But step two, the more important part, is actually knowing what to do about it. And the good news is, there are concrete things you can do to get control over this.
First, tax diversification. It's so important. Having money in both traditional pre-tax accounts and Roth post-tax accounts gives you options and control. Second, think about Roth conversions, especially in those years before you start taking Social Security, when your income might be lower. You pay a little tax now to get tax-free income later when it really matters. Third, if you're over 70 and a half and you give to charity, use qualified charitable distributions. The money goes straight from your IRA to the charity and never ever shows up as your income. And finally, just be strategic. Plan out your withdrawals each year to keep that provisional income where you want it.
You know, the goal here isn't necessarily to pay zero taxes, though that would be nice. The real goal is to be tax efficient. It's about knowing the rules of the game so you're not leaving a huge tip for the IRS. Every single dollar you save on taxes is another dollar you have for your retirement.
So, to wrap this up, the key takeaway is that the tax on your Social Security isn't some random thing. It's based on a formula. And now that you know the formula, I'll leave you with this question. What's the single biggest factor you can actually control to manage this tax in retirement? It isn't how much Social Security you get. It's where you pull your other income from.